You know, the reason the market is very popular is because everyone believes in the American dream. It's a part of the culture. They believe they can become rich very fast. Now, the reality of the situation, that's very rare, extremely rare, but it's happened. And they just assume, because of the media, that the people that did get money, they didn't last long because they weren't smart enough. But everyone likes to think they're different. Hey guys, welcome back to the After Hours. I'm the ATL Beast, and today we're going to talk about penny stocks. So when we're talking penny stocks, we have to understand that we're talking about small companies, and small companies come with inherent small company issues. We're talking about poor management, low quality products, account irregularities. At this point, this company's pretty much a fresh chart. They're a fresh company. There's going to be a lot of kinks that have to be ironed out. What's most important for the growth of these small companies is the sponsor. There has to be someone that's willing to adopt and bring up these small companies because they need to be promoted. They need to be funded. Without proper sponsorship and guidance, most companies fail. So one of the things you have to understand is that it's easy to uplist a stock. When we talk about uplisting a stock, there's levels to it. At the bottom level, you have things called pink sheets in OTC. This is where the majority of penny stocks are. When we talk about the stock market, its main job is to transfer money. Now you're transferring money from the long-term investors inside your company to the short-term investors that are more speculating on your company and following its price activity. They actually don't care about the company's reputation. It's more of just a temporary investment. So if we're looking for max gain potential, most of the time, the majority is looking for long positions. Penny stocks are usually referred to as high risk investments as well as low price investments. So when you have a long-term investor inside of a penny stock, the long-term investor is there for the massive gain potential. Now we're talking about this person buying the stock when it's under $1, then selling it when it's somewhere above $10. But when does that actually happen? Does the company have control over that? The answer to that, kinda. What happens is penny stocks hire promoters. Their job is to make sure that enough traffic goes into their stock. And those type of people usually have a part of their income that they consider a lottery size. Now, this lottery size, they want to use it as much as possible. So let's explain the difference between a retail investor and how they use penny stocks versus an institutional investor, how they use penny stocks. So when it comes to the long-term investor, they get in at the beginning when there is an accumulation. It's when the stock price is very low. At this point, there's low volume, there's lack of liquidity, and there's very limited financial disclosure. Long-term investors have time on their side. They're very patient. All they have to do is wait. And what are they waiting for? They're waiting for the pump. Now, who's going to pump this stock? Well, that's going to be the stock promoters as well as the insiders. Now, when we talk about the audience for these two pumpers, it's the retail investors. Now, when we look at retail traders, we understand that they are following the crowd. They're following the leader. They're following the leader inside of the stocks. Penny stocks are stocks that are under $5 per share. They come with a lot of risk, and these risks are because of fundamentals. Now, with bad fundamental stocks, we understand that's because they're small companies. These can't be fixed in a short amount of time. And the slim chance that they can be fixed, it's usually because of a big sponsor. That means a big company or a big investor has come to promote the stock. And you only see that with a takeover or a merger. When we talk about retail markets, we understand that people want to get rich quick. And you're not going to get rich using a little money in a safe space. That's why they come to the high risk, high potential markets. That's penny stocks. You have to understand that things are not always what they seem. There's a lot of sketchiness. There's scams. And most of these scams are going to be in the OTC. This is pretty much known as the stock market ghetto. A lot of people come to the market with a reason to buy. The reason that they buy is because they believe this stock is at a discount. Think it's at a discount because they believe in the mission of the company. Or they just believe that there is potential gains inside of this company. So if I get on now, I can get more money for later. More practical and realistic people, they look at this company. They understand that it's a small company, and they weigh the odds that a small company becoming a big company is very low. That normally short the stock. They are very pessimistic. That's because they'll do their research. In their research, they'll see that their customer base might be lacking. There's no operating history. Maybe there's limited financial disclosure. This company is going to go down. Or people are going to wake up to this after the crowd gets finished gambling, which might take as long as 3 days or as little as half an hour. We understand that the person that loses out the most inside of this whole process is not the company, is not the long-term investor. It's the retail investor. When we talk about foreign companies, there's usually a reputation that comes with it, and that reputation is scams. When we talk about scams, the number one scam we talk about is pump and dumps. So to help us understand, we're going to look at MLGO this week. President Biden just mentioned another wave of forgiveness, which means more taxpayer money is going to help towards paying students. Because of that, a lot of people are sensitive towards learning topics. And because of that, you had retail volume flock to the MLGO. Now there's many types of pumps that you can have. You can have some where they halt up. You can have others where there is short squeezes. Maybe even some where there's just a massive parabolic or supernova. But the biggest identifying factor of a pump and dump is that it goes up too fast and it goes down way too fast. Now, with MLGO, we have to understand the psychology and what actually happened on day 1 and day 2. When we look on the daily chart, we see a massive resistance. Now this resistance has 80 million and it goes up to $10. And when we look at the previous day before the gap up, this stock was trading at $2 and it had very little volume ever since that massive spike. All right, so when we see stocks like this, we understand that stocks don't go straight up and they don't go straight down. But in the times that they do, it's probably a scam. Well, at the end of the day, these stocks, they're made off people's observations. And sometimes you can see the wrong thing because it's based off of your personal experience. And the people that uplist these small companies, you have to understand, most of them are here for the retail money. The money doesn't really come from the sponsors. It actually comes from everyone combining together to take the retail money. So was this trade avoidable? Yes. Was it profitable in both directions? Also yes. But in the long term, this is the textbook high risk, high reward penny stock. All right, guys, that's all I got for you today. If you like what you saw, hit the like and subscribe button, and I'll see you in the next video. Peace.